talk a little bit about how we see oil and gas here in the next next couple of years. So for those of you who've been here before, we like to do these set of messages. So 6 key messages here for the oil and gas industry as we see it over the next few years in the near to medium term. Bottom line, I think this year is going to be a bit challenging for crude oil in particular. We think crude oil demand is fairly sluggish right now. We think that there's extra supply of crude oil into the market. So we essentially see oil prices under a lot of downward pressure this year. So that's the first message. Second, for natural gas, its fortunes are increasingly getting tied to what happens to exports. Brad talked about this a little bit earlier today. So essentially LNG exports and to a certain extent some sort of a resurgence in power generation, not just because of data centers but also because of additional gas-fired power generation capacity that we now expect in the US. So we see a little bit of growth in both of those markets, essentially supporting natural gas demand. But and Brad alluded to this as well earlier. The problem with natural gas is it's being constrained by demand, and so if the US doesn't quite invest in export infrastructure, then the natural gas market is not going to see the growth and the potential that the onshore shale resource base offers us here in the US. In terms of supply, it's really Haynesville, where we are seeing a lot of growth in supply, primarily because of its proximity to a lot of LNG export terminals, and then of course Permian. And Permian, a lot of it is associated gas production, so its economics are independent. The economics of producing gas in the Permian are independent of broader gas pricing, right? They are more driven by what oil pricing looks like. Third, we see LNG markets also seeing some growth here. We expect capacity to grow. 2 new terminals actually achieved first LNG right pretty much on the last day of December last year. So we think that should create some additional demand for natural gas. But broadly speaking, there's a shortage of LNG globally, right? And so we expect LNG capacity, a strong need and desire for LNG capacity and supply here over the next couple of years. Fourth, midstream, we are obviously well past that big build out of midstream infrastructure that we saw, let's say, into the years leading into the pandemic. But we still see very interesting growth opportunities in midstream oil and gas infrastructure. So we'll talk about that a little bit at a high level. Most of those opportunities are related to infrastructure that is tied into export capacity. So think of pipelines feeding into LNG export terminals. Think of natural gas storage capacity, for example, in order to provide more stability for gas-fired power generation to respond to fluctuations in renewable power generation. So there are some interesting growth opportunities in midstream as well. Refining is probably not as rosy a picture. So for clients who are tied a little more closely into refining and downstream, it's going to be it's not going to be exactly a very optimistic outlook, but we expect moderate kind of returns, crack spreads, and performance here into refining, and we're going to learn a little bit more about that. We have 2 great speakers on the refining panel later this afternoon, so we're going to learn about that a little bit more. And then finally, broadly speaking, there's a lot of deregulation that is anticipated in the second Trump administration, which we think should be helpful for the oil and gas industry. But tariffs and related trade wars are obviously not helpful, given the fact that the US oil and gas industry today is more of an export-driven industry. Its fortunes and growth are tied to our ability to export hydrocarbons, and obviously tariffs and associated trade conflicts are not helpful for that. So that at a high level is our view. So let's talk a little bit about crude oil. So globally speaking, we were a little over 103 million barrels per day of demand last year. We expect another roughly a million and a half barrels per day of growth here over the next year or so. A lot of this growth is going to come from the usual suspects, right? China, obviously, a little short of a million barrels per day. We think that India is going to contribute roughly another 100,000 barrels per day or so. The rest of Asia, excluding China and India, roughly another couple 100,000 barrels per day. So that's what is going to drive. But we also expect growth in Latin America, for example. That's about another couple 100,000 barrels per day. So, if you looked at this picture 5 years ago, the tranche associated with China, for example, would have been much larger, almost over a million barrels per day. Today, that's about half of that. And frankly speaking, we don't have enough certainty into how firm that incremental demand from China is going to look like. Demand signals for oil from China have become very difficult to read, primarily because there has been a big shift away from traditional refined products over the last few years. So, and we'll talk about this a little bit here, but the rise of LNG-based trucking in China is having a material impact on diesel demand, for example, in China. So collectively we see growth, but it's going to be fragmented across multiple geographies. And obviously, when that happens, there's a lot more uncertainty that creeps into our forecasts. But overall, think of a little over a million barrels per day of incremental demand for crude oil here next year. So given that, what does the supply stack look like? And this is where the problem begins. From a supply perspective, we actually think close to 2.5 million barrels of additional supply, liquid supply, crude oil and natural gas liquids flowing into global oil and gas market. So it's roughly twice of what we are expecting in terms of demand, which is not helpful for oil prices. US shale will continue to grow. We think roughly another 600,000 barrels per day, both crude oil and NGL supply, and a big chunk of that is actually NGLs, will flow into the market from onshore shale predominantly and some startups of offshore projects. But a lot of the growth is actually coming outside of OPEC or the US. It's coming from Brazil, for example. It's coming from Argentina, where some of the shale projects are moving forward. Vaca Muerta, for example, it's coming from traditional or the usual suspects, for example, Guyana, which has been building capacity over the last few years. So a lot of the growth that we are going to see is already kind of baked in, and there's little that you can do. Unlike shale, a lot of these projects can't turn off supply on a dime here to respond to oil prices. So broadly speaking, we expect roughly 2x of demand flowing into global crude oil markets over the next year or so in demand growth. Diving a little deeper into the US, so we have two charts here. On the left is US crude oil production, and on the right we are showing our base case, and we are breaking it down by type of production. So roughly speaking, if you just look at crude oil and don't look at NGLs, right, we are roughly expecting another 300 to 600,000 barrels per day of production, depending on, there's some uncertainty there. And going forward through 2030, we think that US crude oil production should be roughly around 15 million barrels per day, potentially a little bit higher. If you look at the chart on the right and you break it down, you'll see that the bulk of that is all coming from onshore shale. And in fact, the other two stacks, including offshore, is going to decline a little bit, maybe marginally, but we're going to see some decline. Primarily because of capacity being retired over time and things like that, especially in offshore. But that's the picture that we see here. One of the key points on this chart, especially the chart on the left, is how little shale grew in 2024. This is probably one of the first years, except for maybe 2020, where shale hasn't quite surpassed expectations. If you look at our forecasts for shale production growth over the last 10 years, pretty much every year shale has produced more than what we had forecasted. And this is probably the first year where actually onshore shale production of crude oil has been roughly on target of what we were expecting, roughly 300,000 barrels a day or so, which we think is good news, right? It shows that there's a lot more capital discipline. Consolidation has led to a more rational, economics-driven behavior in the market. And that we think is helpful, right? It allows U.S. Oil and gas industry to be a lot more competitive. Permian's the story, which is why Brad is spending so much of his time in the Permian, which is why anybody who is in the business of selling equipment and services into oil and gas markets are spending so much time in Permian. We expect Permian to grow by 5% every year through 2030. And it's really taking share from a lot of the other plays, right? If you look at Bakken, which is the other big oil play, right, it's pretty much going to be stagnant through 2030. So if you are a player that is focused predominantly on Bakken, the crude oil growth story is a little bit challenging. We did a big piece of work last year for a company that sells production and oil field chemicals primarily into the Bakken, and it was a strategic imperative for them to diversify out of the Bakken. Otherwise, it was going to be very hard for them to continue growing, because otherwise you're essentially taking share from others, and there's only so much share that you can take from others. So Permian is where we expect all the growth. So collectively, we think oil prices in the best case should be in the 70s. We think there's a pretty strong chance they might come down into the 60s. So we essentially think it's going to be a difficult year, and we expect oil prices to kind of languish in the 60s, potentially 70s. If it stays in the 70s, that's actually going to be more like an upside scenario for us. In terms of risks to oil prices, what do we see, right? Let's maybe start with the upside drivers, try to be a little more optimistic here. But if there are much stronger sanctions on Russia and Iran, we think that could help. But Russia and Iran both have been operating in some sort of an environment where they've had some sanctions for a very long period of time. Iran for sure, and they have developed other markets. Iran sells a lot of oil to India, for example. So therefore, the ability of sanctions to hurt countries like Iran and Russia is a lot lower now than it was, let's say, 5 years ago. So there's limited opportunity there. This is where I personally believe that there's potentially more opportunity if Asian economies, in particular China, grows faster than expected. The post-pandemic recovery of China has been very lumpy and has been very difficult to read, and it's hard for us to understand why that is the case. It hasn't quite replicated the same playbook that we've seen in pretty much all other parts of the world. And so if we see some changes there, then we expect that potentially to have an upside on oil prices. And then weather, right? It's interesting, but if you asked oil market analysts what role does weather play a year or a couple of years ago, they would have said, well, you should be talking to the gas market analysts, because those are the guys who are most impacted by weather. But last year in 2024, significant amount of oil production capacity was curtailed because of weather. And so it's interesting, but we are getting to the point where weather is starting to impact some of the oil production as well. Downside risk, tariffs are not helpful. The US exports a lot of crude oil, and a lot of these countries are going to respond with retaliatory tariffs. We are already seeing a lot more protectionist behavior in a lot of other parts of the world, and that's only going to intensify. So conflicts around trade are not going to be helpful. If Chinese economy continues to struggle, roughly a third of our supply outlook roughly half of our demand growth in crude oil is tied to China. So if the Chinese economy struggles more or tends to be softer, then that's going to have an impact. And then, of course, if there are no additional sanctions, or if sanctions are limited on Russia and Iran, there's more barrels hitting the market that will have an impact a downward impact on oil prices. So let's talk a little bit about gas. So the chart on the left shows gas production here in the US. And again, you'll see a lot of discipline in the market, fairly marginal increase in gas production here in the US in 2024 relative to 2023. Of course, a lot of that is driven by the fact that there was no new incremental natural gas export capacity or LNG export capacity that came into the market in 2024. It came on the last day of 2024, right? 2 additional terminals achieving first LNG, Venture Global and Corpus Christi. So obviously, we'll see that kind of baked into our forecast for additional demand and therefore additional production for 2025. So that's why you see about roughly 3 BCFD of growth in the high case that we anticipate in 2025. Where is all of this gas going to come from? Haynesville, as I said earlier, it's nicely located very closely to a lot of LNG export terminals. So we see a lot of growth. In 2023, 40% of incremental gas production came from the Haynesville. That number is not that big today, but it's still a fairly significant number. After Haynesville, we see Permian growing quite well. Of course, a lot of that is associated gas. And then finally, Appalachia. Appalachia is growing, but very minimally. And if there is one thing that I'm really looking forward to from a deregulatory agenda under the second Trump administration, it is deregulation of permitting associated with pipelines. There's a significant amount of latent demand in the Northeast that can be nicely served by Appalachian production in a very sustainable fashion, but that's not moving forward primarily because of permitting challenges. If that is resolved, that can be a nice uptick into additional incremental growth that we can see for gas production and demand here in the US. So, Brad kind of beat me to the punch here, but he had a similar chart that was a little bit more optimistic around data centers. But, and I think he talked about it, nobody really knows, and I would agree with that. Not a great message for an industry analyst to say that, but this is the best that we can put together based on how we see the world today. But obviously, over the next year or so, on the chart on the left, what it shows is where is incremental natural gas demand going to come from, right? So we're going to see gas demand primarily from LNG exports, some pipeline exports, but then a nice bit of growth that is coming in from power generation. If you looked at the same chart last year or the prior year, that power generation tranche had started becoming smaller. But we are seeing now new investments in gas-fired power generation capacity. We are seeing incremental demand coming in from data centers that is supportive of demand. But that's where we see growth. We also see growth in there's a lot of industrial activity that has come back to the United States in the last 4-5 years, which we think has been supportive of electricity demand that is translating into gas-fired power generation capacity. This is a chart that I love to show. I've been showing it for 15 years. This is probably one of the first charts I built as a consultant when I started ADI, because when in 2009, when I started ADI, one of the first questions a client asked is, okay, we're producing so much gas, where is all this going? And I really didn't have an answer to that question. So I came back and started digging to look for information on where is gas going, and then we started building this chart, right? This looks at gas demand in 4 big segments: residential, commercial, industrial, and power generation. And for many years, if you look at the CAGRs, right, it was power generation that carried the day for natural gas demand. That started to slack off in the last few years, and a lot of people thought that natural gas use for power generation had kind of run its course and additional growth will be very hard to get. But this year is showing that, okay, there can be more room for gas-fired power generation capacity. What is happening is renewable power generation capacity has grown very quickly here in the US, but you need backup gas-fired power generation to fill for the gaps when renewable power generation is low because the wind is not blowing or because the sun is not shining and so on and so forth, right? So we continue to see growth and expect growth here from power generation for natural gas going forward. Having said all that, I think gas prices are still going to be low. we think that gas prices will probably stay a little over $3. If I had a view of this 10 years ago saying that gas prices will stay a little over $3, a lot of our operator clients would have been disappointed. But after gas prices middling around $2.50 for the last year, when we show a forecast saying that gas is going to be about $3, a lot of people are happy. So it's all relative, right? What your expectations are and how do you manage them? In terms of upside drivers, I think going back to the point that Brad was making earlier, if there is a dramatic adoption of data centers and the use of gas because finding cleaner power than gas-fired power generation becomes harder or takes longer, then you're going to see an uptick in gas prices. If we see continued growth in manufacturing capacity, we could see potentially higher gas prices, and then of course weather-based disruptions. In terms of downside risks, the biggest downside risk that I see is further delays to LNG export capacity. This has been a pain point in general for the LNG industry, is that these projects are never done on time, they never come on stream on schedule. They probably cost a lot more than what initially projected, and maybe the LNG panel will talk about that a little bit here later today. But that's the biggest risk, right? So if you see further delays for some of the capacity that we expect to come on stream, or some of the capacity that has achieved first LNG continues to, let's say, have low utilization rates, I think that's going to hurt natural gas prices. So let's talk a little bit about LNG. This is where I think there's a lot of interesting stuff happening as we go along. But let's set fundamentals a little bit, right? I mean, the global LNG industry today, growth is driven primarily because of what happened with the Russia-Ukraine conflict. Collectively, we lost about 13, 14 BCFD of piped gas that was flowing from Russia into Europe. And we lost that in three tranches, right? The first big tranche was in 2022, a little over 8 BCFD, and then another 3.5, 4 in 2023. And even last year, we lost roughly 1.5 BCFD of gas flowing into Europe, right? Now, Europe has done well with energy efficiency. They have cut their gas gas consumption by 8 to 10%, but you still need all of this gas. The global LNG industry has done very well in responding to that, and a lot of capacity has been diverted into Europe. And we have seen some incremental gas volumes being piped in from other places. We have seen some other supply of natural gas flowing into Europe. But in spite of all of that, right, we are still 3 BCFD short to replace all the piped gas that we've lost flowing into Europe. And this is just the European picture, right? One of the things people don't appreciate is some of the LNG that is being diverted into Europe is not flowing into Asia, where there is demand for natural gas. So conceptually, the latent demand for LNG capacity is more than this 3 BCFD that has not been met. And I think that's really what is driving a lot of desire for new LNG supply and new LNG capacity globally. The good news is that the industry is kind of reading these signals and responding. The chart, this page here shows two charts. The chart on the left shows US LNG export capacity and growth outlook, and the chart on the right is the same except for it's a global view. So obviously US LNG export capacity, the upside is much higher. We expect potentially more LNG export capacity that can come to the US. Globally, we think that capacity will grow roughly about 2.5 to 4% or so. So these are fairly decent growth rates for LNG capacity. There's a lot of projects in the pipeline. This is just a view for the US. So in 2024, we had roughly about 76 million tons per annum. The 2025 stack includes Corpus Christi and Venture Global's Plaquemines plant, both of which achieved first LNG late December. So we expect that to account for the supply stack here. And beyond that, there are lots of projects that are coming up, but some of this capacity has been delayed, right? Golden Pass, for example, was supposed to have started up by now, but it's running behind. The projects that are expected to start up in 2028, 2029, there's probably a little bit more uncertainty associated with them, but we expect quite a bit of the supply stack to come through, and a lot of the supply stack should do quite well economically given the broader need for LNG on a global basis. We have a similar picture outside the US as well. Globally, there's lots of LNG capacity that is vying for attention. We think that a lot of this capacity is at a higher risk for delays given broader geopolitical risks, given the fact that a lot of these projects are in relatively difficult parts of the world, and that some of this capacity has multiple stakeholders whose interests keep changing because of various reasons. A great example is the availability of capital from European banks into oil and gas projects. That has declined dramatically, and so a lot of stakeholders who are willing to invest in LNG capacity globally, are rethinking, especially if their source of financing is tied to European capital. So there's some risk here, which all collectively means that it's good news for people who are trying to develop LNG export projects here in the US, assuming they can bring those projects on time and on budget. So if we zoom out a little bit and take a look at what's happening in gas markets globally, right? In the near term, we have seen actually gas prices rise, right? Because of shortfalls in storage levels for natural gas in Europe. We're going to have Marcus from Horbiger talk about, bring that European perspective into gas and LNG markets later today. So that'll be a very interesting panel and perspective to hear. But we because of colder weather, because of alternative power generation falling short, Europe is short on its gas, and its gas inventory levels are actually dangerously similar to what we saw in 2022. So that's why gas prices are rising globally, and some of that is being felt here in the US as well, because a lot of that would have to be met through additional incremental LNG supply. Now, in spite of all of that, right, what is happening is that there is a much tighter correlation between natural gas prices here in the US versus in Europe and in Asia. So, and this correlation is getting tighter. A lot of this is driven because of fairly cheap supply of LNG here in the US, and a lot of this supply being tied more closely to Henry Hub as opposed to the traditional model of pricing that was available before US LNG capacity came on stream. We think that this is good news, right? Because a market where gas is priced globally is going to incentivize demand for LNG. It's going to incentivize displacement of coal-fired power generation with LNG. It's going to provide revenue security and stability for a lot of new LNG export projects. So, we think that this is going to be supportive. It'd be very interesting later on the LNG panel. We have Vivek, who's going to talk, who's from Texas LNG, trying to develop a new project to export LNG, and that perspective should be very interesting for us to hear from later today. Now, having said all this, right, the markets, at least in the long term, seem to have missed the memo that there is a shortage of LNG and that we need a lot of LNG. Long-term LNG prices have been remarkably calm, and the broad consensus is that this is because there's a lot of confidence that a lot of new LNG capacity is going to come on stream, and therefore pricing is going to be stable here going forward. So let's talk very quickly about Midstream here. So lots of growth opportunity. I mean, there's lots of places where you can build midstream infrastructure, right? You can build pipelines to take crude oil out of the shale plays into the export terminals or into the refineries. You can do the same thing for natural gas. You can build gas storage capacity. You can build LNG, LPG export terminals, right? There's lots of opportunities for midstream capacity. But we think that a lot of that capacity has been built over the last 10, 15 years, and a lot of the growth going forward is going to stem from infrastructure that is needed to feed export capacity, whether it is crude oil export terminals, as LNG export terminals, LPG export terminals, and to build more resilience in the system. So that's why we see natural gas storage as being fairly attractive. We see pipelines feeding into export capacity being fairly attractive. So that's where we're going to see growth here. Again, I think we're going to hear from Martina from Turaga Resources. That would be a very interesting perspective on the Midstream panel to see how they think of growth going forward and what are some of the challenges to bring some of that growth forward. Everybody has heard about the crude oil export story out of the US, the LNG export story. What not enough people appreciate is how much of lighter hydrocarbons, natural gas liquids, LPG, ethane is being exported out of the US. An interesting LPG export terminal got announced in the last couple of months by ONEOK and MPLX. Phillips 66 made a big NGL pipeline acquisition, which we think will lead to an investment in an LPG export terminal. Ethane exports are growing rapidly. In fact, we can export a lot more ethane if we had the right fractionation infrastructure and the right pricing dynamics between ethane and natural gas. And of course, more ethane export infrastructure. So there's a lot of potential growth opportunity that exists in LPG and ethane exports as well. Crude oil exports, a lot of it now flows out of the terminals in Corpus Christi. We think that there is sufficient export infrastructure for crude oil today, and given that crude oil prices are going to have some sort of a bearish year in 2025, we think that there is sufficient pipeline capacity for crude oil exports. So let's talk very quickly about refining. Globally, refining capacity will continue to grow, of course, at a very modest pace, a little over 1% or so. So that's lower than what crude oil demand is expected to grow. So that kind of tells you that there is surplus capacity in the system or demand growth associated with refining capacity for various reasons, in particular the emergence of alternative fuels, biofuels, for example, or the use of LNG in heavy-duty transportation is having an impact. And of course, electric vehicles for gasoline markets, all of that is having an impact. Here in the US, we are seeing a couple of refineries being shut down, repurposed. So we're going to see some reduction in refining capacity. But the US still has surplus refining capacity, and we export roughly a couple million barrels per day of refined products every year into Latin America. So Latin America has really been what's been helping a lot of the US Gulf Coast refining complex kind of manage this surplus capacity that they have had. Crack spreads, we are obviously well below the peaks that we saw right after the pandemic. Going forward, we expect crack spreads to pick up a little bit, roughly into $20 a barrel or so. This is a blended crack spread for all of the US. Obviously, the crack spread varies dramatically if you're in PAD 5 versus PAD 3, and all of this all of this changes based on the specific dynamics of each of those regions. But a lot of the US refining complex also depends on imports of crude oils, especially a lot of the Gulf Coast and the Mid-Con refineries depend on a lot of Canadian oil that is imported into the US. And what happens to the supply of that crude oil, what happens to the price of that crude oil because of tariffs has a big role on what the overall health of the refining complex looks like. Chinese refining capacity is oversupplied right now, and they are struggling. We expect crack spreads in China to fall to roughly $5 a barrel. We think a lot of refining capacity is going to go out of the market. In China, they continue to have a lot of fairly low conversion refining capacity that we think is going to go out of the market. China has done an incredible job of developing alternative fuel-based infrastructure. Their LNG truck fleets have grown very quickly over the last few years. We publish a study on small-scale LNG every year, and we talk a lot about this. But frankly speaking, globally, LNG use in the transportation space has grown very, very slowly. And this is the first time where we are seeing much rapid growth and adoption of LNG in the transportation space. We're going to have Sean Davison, who operates in the small-scale LNG space with Pilot LNG, on the LNG panel later today. So it'll be interesting to kind of see his perspective on this in this space. Tariffs not going to be helpful for the US refining industry. A lot of Canadian oil flows into the refining complex here in the US, especially Mid-Con and to a certain extent the Gulf Coast. They could potentially source alternative crude oil volumes from, let's say, US shale plays, but a lot of those refineries have been configured to process heavy crude oils, and that's how they make higher crack spreads, and some of that, in comparison, light tight oil out of the shale plays is a very different animal. So you're not going to see this. You're not going to be taking advantage of the refining kit that you have if you make that switch. So broadly speaking, we see tariffs, not being helpful for the U.S. refining complex here going forward. So with that, we've been doing a lot of work in the last 6 months trying to understand what President Trump's going to do in his second administration. Understandably so, we appreciate the business, but frankly speaking, who really knows, right? So this is some work that we put together on what does President Trump's support look like for different segments: upstream, midstream, LNG exports, biofuels, deregulation of EPA rules, and that traffic light tells you, right, that he's supportive of deregulation. He loves the oil and gas industry. He is in favor of faster permitting of new energy infrastructure, for example. On the flip side, the stuff onto the right, he loves coal, but he doesn't, and natural gas and nuclear power. But his support for some of the other parts of the broader energy space are not great, right? So offshore wind, for example, is something that he has explicitly come out and stated his opposition for. Interestingly, grid infrastructure, right? Trump is not very supportive of investments in the grid infrastructure, although he's very supportive of investments in oil and gas infrastructure, mainly because they tend to view investments in grid infrastructure as being supportive of, let's say, greater adoption and rollout of electric vehicles. So anyways, so that's what we see as stated positions in terms of support on different aspects of the energy and oil and gas industry. But what impact will it actually have on the industry is a different question. And that's what the next page is showing, right? And we think that except for LNG exports, a lot of these things are not really going to impact how each of these industries is going to perform. Obviously, there are a lot here, but so I don't intend to go through all of that, but I'll take the example of grid infrastructure, for example. In spite of the opposition to make more investments in grid infrastructure, a lot of that will have to go through FERC, which is currently deadlocked, and it will take Trump at least a couple more years to kind of resolve that in his favor with the right composition of commissioners within FERC, right? So essentially, decision-making is not going to swing very rapidly against grid infrastructure investments. Similarly, if you take a look at methane emissions, for example, President Trump's agenda for deregulation should lead to some curtailments and restrictions on methane emissions. But if you go and talk to the large LNG exporters, a lot of them are serving markets in Europe, for example, which have established very clear methane intensity rules and regulations. And essentially, a lot of LNG suppliers will have to comply with that. So operationally, a lot of LNG exporters and the broader infrastructure is preparing to reduce their methane emissions intensity. And I think to a certain extent, Brad in his presentation was alluding to some of that here this morning. So I think there's there's going to be a lot of noise, but to what extent is that truly impacting the oil and gas industry? We think that the impact is going to be a lot limited. The last piece is upstream oil and gas production, right? I mean, President Trump wants to drill. He wants to make permitting easier, but oil prices haven't quite seen the memo, right? I mean, oil prices are low. There's oversupply in the market. Demand is not picking up. And onshore shale players, as I talked about earlier, have shown remarkable discipline in terms of managing production growth. So therefore, we think that the overall impact is going to be limited. Finally, I think we obsess about policy, but markets have a much bigger impact, right? What we are showing here is how different segments have performed under different precedents over the last 15, 20, 25 years or so, right? In spite of all the opposition to oil and gas, shale has done incredibly well under both President Obama and Biden. In spite of all the opposition to wind power, the best years were under the Trump administration. And coal retirements, in spite of all the support for coal, actually were the highest under the Trump administration. So I think we need to have some sort of a balanced view of what is actually feasible and how markets and economics have a much bigger impact than policy over the course of a presidential administration. The last thing I want to say is we are showing here the different stuff that US exports, right? Most of these are hydrocarbons. And of course, we have coal as well and biofuels as well. I mean, the US energy complex today is predominantly driven by exports, right? And all of this is going into places all over the world. And any policies that have an impact on the ability to export will have a massive impact on the competitiveness of the US oil and gas industry. So with that, I'll wrap this up here and see if there are any questions.
Hey, Uday, thanks. Excellent work here. Just a question around the interplay between, because you did make one mention on the interplay between gas, and obviously a lot of that gas in the Permian is associated gas, but almost conflicting, drill baby drill. Yes, we have more oil, but then lower prices. And can you just walk through maybe some of the implications, because of that conflict, right? How are we as a country, how is Trump, et cetera, how is the industry going to manage that potential conflict?
Yeah, so I think one of the challenges, associated gas production is a real problem, right? And I'm not sure if the industry really has thought through how to address that, right? Because Permian is definitely where the most competitive oil production is. But Permian wells are maturing, and because Permian wells are maturing, the gas to oil ratio is increasing. So for every barrel of crude oil that you're producing, every day you're producing more gas than you did the prior day, right? And you need to find an outlet for that, right? And the outlet is increasingly LNG exports, right? Maybe potentially now data centers and power generation a little bit. But at some point, right, we are going to get to a stage where, if you look at, we are probably already there, right? If you look at Waha gas prices are routinely negative over the course of a year, right? So essentially they are paying somebody to take their gas away. I think we're going to get to that stage here in the next few years or so, and there are no good answers to that, right? Many years ago, when North Dakota had just instituted rules against flaring and said that new permits for drilling would be tied to operators' plans for gas use and gas capture, and there wasn't sufficient pipeline infrastructure. Operators, these are large operators, were planning to build essentially heat sinks, right? They were going to take gas and run it through a resistor and essentially produce heat, because they just didn't know what else to do with the natural gas. So, I mean, obviously markets respond, right? I mean, markets are not stagnant, right? So once that happens, there'll be interesting businesses that come forward. But I mean, you've hit the nail on the head. That is a real problem that's looming for the oil and gas industry here in the next few years.
When we look at the current price of crude in the United States using the dollar, what percentage have you guys factored in as to the inflation effect on the actual price of crude? So meaning, for simplicity, is $70 the pre-inflation $50 price of crude? We had a significant inflation for 4 years. So, and inflation is still high relatively. So we're going to continue to see materials costs, production costs, wage costs go up. So that's my question.
Yeah, I mean, so oil prices are set globally, right? I mean, the price, the $70 price is essentially the price the last consumer using oil is paying for that barrel of crude oil, right? So it's essentially tied to demand. I mean, conceptually, OPEC can produce another 3-4 million barrels of crude oil today. They would like to actually, but they're not able to produce that because there is so much of supply that is coming in from other parts of the world, right? Some of which is not necessarily tied entirely to economics. So when inflation happens, right, it's the operators that are eating the cost, right? So if you look at if you listen into earning calls from the large operating companies, every quarter they'll tell you what service costs are doing, how is inflation in service costs impacting lease operating expenses or their break-even costs of producing oil. So essentially, that's where the cost is being absorbed to a large extent. Overall, crude oil prices are not really responding to inflation as such.
Your forecasts and projections for crude oil demand and products demand out to 2030, including the crack spreads. Are those still on the premise of your projections on the premise of EV mandates?
Yeah.
And should we make an adjustment then to account for that, since EV mandates are now off the table?
Yeah, I mean, I think we are definitely getting to the point where the EV fleets are having an impact on gasoline demand in particular, right? And like even alternative fuels like LNG-based trucking, for example, is why we see distillate demand, diesel demand being softer in China, for example. So we are definitely factoring that in. But the forecasts that we showed you were primarily for onshore shale, right? Which is roughly about 13-14% of overall crude oil demand here in the US today. So that forecast is to a large extent driven by the ability of US onshore players to respond. You know, if we were to show you our forecast for oil demand globally, then, you know, we can very clearly show you what percentage of that relative to, let's say, our forecast for 5 years ago, you know, what percentage of that is being lost because of EV penetration, because of higher fuel economy of the vehicle fleets, because of greater penetration of biofuels and things like that. But yeah, I mean, we do factor some of that in, and we are getting to the point where some of that is eating into oil demand. I mean, conceptually, there are people who think, there are some of our peers who think that that China has peaked on gasoline demand. We believe that US has peaked on gasoline demand. If you look at, and I think we're going to talk about this, I think in the fuels and refining panel, there's some of our research. We spend a lot of our time trying to understand what's happening to emerging markets, which account for a lot of oil and gas and energy consumption. Energy growth in fuel refined product growth in India, for example, is slowing, and you'll see some of that research here later today. But yeah, I mean, broadly speaking, we are getting to the point where some of these alternatives are having a material impact on crude oil demand.
Thanks, Uday, for the great insight. You talked about a support to the methane upstream emissions by Trump administration in terms of regulations. Last year, EPA came up with a rule called WEC waste emission charge, charging $900 for every ton of methane that goes. And this is going to getting stricter in 2025, 2026. So when you say Trump support in terms of regulation, do you mean this rule is going to get waived off or to simply go away with this ruling?
Yeah, and so I'm not sure. I think the Trump administration is in strong favor for deregulation, right? So we do think that they will try to deregulate or reduce the efficacy of the waste emissions charge or delay Quad OBC, which are other rules that have an impact on methane emissions. Our perspective is that there will be efforts made to do that, but the actual impact is going to be limited, primarily because the waste emissions charge is part of the Inflation Reduction Act. The Inflation Reduction Act funnels a lot of cash into a lot of red states along with blue states. So you need congressional approval. Right now, you could use rulemaking. Agencies can use rulemaking to say that, okay, it's not going to be $900 a ton, it's going to be $300 a ton, right? So there's potential for that to happen. But again, to what extent will that impact? Because we think that, and we'll show you some research later today, where we look at various operators and where they are relative to the waste emissions charge. A lot of them are actually below the threshold where the waste emissions charge is triggered, right? So in other words, operators are moving somewhat independently and ahead of what the regulatory framework looks like. Quad OBC, we think, is potentially at risk. It might be delayed. But again, I think a lot of the effort on methane emissions is today independent of what the regulatory framework looks like, primarily because you're serving markets like Europe, which are saying that you need to be a lot more competitive from a methane emissions point of view.